This LOS is explains systematic and non-systematic risk, including why an investor should not expect to receive additional return for bearing non-systematic risk. What is the market? The optimal risky portfolio and the capital market line depend on the definition of the market. So what is the market? Theoretically, the market includes all risky assets or anything that has value, which includes stocks, bonds, real estate, and even human capital. Not all assets are tradable, however, and not all assets are investable. If we consider all stocks, bonds, real estate assets, commodities, etc., probably hundreds of thousands of assets are tradable and investable. The market should contain as many assets as possible. We emphasize the word possible because it is not practical to include all assets in a single risky portfolio. Again, this is all going back to portfolio management theory and the academic theory. So in theory, the market includes all the risky assets. But in practice, and for our purposes, we will use the S&P 500 index as the market's proxy. The S&P 500 is commonly used by analysts as a benchmark for market performance throughout the United States. It contains 500 of the largest stocks that are domiciled in the United States, and these stocks are weighted by their market capitalization, price times the number of outstanding shares. So the S&P 500 is a market cap weighted index. The stocks in the S&P 500 account for approximately 80% of the total equity market capitalization in the United States, and because the U.S. stock markets represent about 32% of the world markets, the S&P 500 represents roughly 25% of worldwide publicly traded equity. The use of this proxy is sufficient for our discussion and is relatively easy to expand to include other tradable assets. Systematic and non-systematic risk. Systematic risk is risk that cannot be avoided and is inherent in the overall market. It is non-diversifiable because it includes risk factors that are innate within the market and affect the market as a whole. So we say a rising tide lifts all boats. So systematic risk is factors that affect the entire market. Examples of factors that constitute systematic risk include interest rates, inflation, economic cycles, political uncertainty, and widespread natural disasters. These events affect the entire market, and there's no way to avoid their effect. Systematic risk can be magnified through selection or by use of leverage, or diminished by including securities that have a low correlation with the portfolio, assuming they are not already part of the portfolio. Non-systematic risk is risk that is local or limited to a particular asset class or industry or company that need not affect assets outside of that asset class. Examples of non-systematic risk could include the failure of a drug trial, major oil discoveries, or an airliner crash. All of these events will directly affect their respective companies and possibly industries, but have no effect on assets that are far removed from these industries. Investors are capable of avoiding non-systematic risk through diversification by forming a portfolio of assets that are not highly correlated with one another. Investors do not receive any return for accepting non-systematic or diversifiable risk. We can assume that in an efficient market, no incremental reward can be earned for taking on diversifiable risk. Total variance equals the systematic variance plus the non-systematic variance. Systematic and non-systematic risk. So here we have a little graph. On the y-axis, we have the variance of the market portfolio, and on the x-axis, we have the number of stocks starting from 0 up to 30 in this case. And you can see systematic variance is variance that affects all companies, and therefore it levels off at a certain level, okay? That's the variance of the market portfolio. Then, as we said on the previous slide, the total variance is the sum of systematic variance plus non-systematic variance. Non-systematic variance is company-specific variance that can be diversified away, and that's why as we add more stocks, the variance comes down. So if we start here on the left-hand side where we have 1 or 2 or 3 different stocks, the total variance is higher because this company-specific variance, the non-systematic variance, will be high. But as we add stocks, and in this case getting up to about 30, it says at 30 stocks, then the variance of your portfolio is going to be somewhat equal to the variance of the market portfolio. And if the variance of the, if the risk of your portfolio is the risk of the market portfolio, then your expected return would be the market, which is one of the arguments for indexing or passive investing, because if you have a portfolio that is larger than 30 stocks, then you're pretty much going to have the same risk and return of the market itself. So in order to outperform the market, you would need a very concentrated portfolio, perhaps of 20 or less stocks. We're just going to finish this LOS with two quick practice questions. The first one, a completely diversified portfolio will most likely result in the elimination of A, systematic variance, B, unsystematic variance, or C, both systematic and unsystematic variance. The correct answer is B. A completely diversified portfolio, such as the market portfolio, will eliminate all unsystematic risk. Systematic risk cannot be diversified away. So that should be a pretty easy one. You should remember this was the number of stocks. And here from the previous graph, we had up to about 30. We had the systematic risk, which was for the market portfolio, which cannot be diversified away. We add it to the unsystematic risk or company specific. And as we add the number of stocks, the total variance is going to come down to the market variance or the systematic variance, which cannot be diversified away. The y-axis, remember, is the variance. So a pretty easy question. Systematic variance, you cannot eliminate. Unsystematic, yes. So one last quick practice question to finish this LOS. Factors such as fluctuations in interest rates and changes in industrial production contribute to A, systematic risk, B, unsystematic risk, or C, both systematic and unsystematic risk. So the correct answer is A. Systematic market-related risk is caused by macroeconomic variables such as interest rate volatility and variability in industrial production. Unsystematic risk is caused by company or industry-specific attributes. And that's the last slide for this LOS. Thank you.